Ladies and gentlemen, distinguished guests, Your Excellencies, it's a really great pleasure and honor to be back to Dubai and to the UAE. This is a real island of stability in a world that is increasingly unstable, risky, volatile, and dangerous. Here you have economic stability, financial stability, social stability, and political stability. However, if you look outside of this country and this region, you see a situation that is literally of significant, unprecedented, unusual, unexpected uncertainty. Four types of view: uncertainty and volatility. And we have to think about it and try to address it economically and financially and socially. I've recently published a book titled Megathreats, 10 Dangerous Trends that imperil our future and how to survive them, where I argue that there's a confluence of severe mega threats in the world that are putting not only our economy and financial markets and our wealth at risk, but also our planet and the world at large. They're leading to volatility, risk, chaos, and instability across the world. I think that for the sake of investors, there are 5 elements of this instability and these mega threats are worth considering. First one is the risk of the return to inflation and stagflation. Inflation being high and at the same time having a recession, like we didn't have until the 1970s. Stagflation is coming back because on one side we have negative aggregate supply shocks that are hitting the global economy, and on the other side we have very loose monetary, credit, and fiscal policy that fuel aggregate demand and inflation. Connected to the risk of inflation and stagflation, there is today the risk of debasement of fiat currencies. Because of loose monetary, fiscal, and credit policies, there is a risk of a disorderly fall of the value of fiat currencies, including the US dollar that is being increasingly weaponized for national security and foreign policy purposes. 3, we live in a world in which there is today, unfortunately, a geopolitical, not recession, but a geopolitical depression. There is increasing rivalry between on one side the US, Europe, and the West, and 4 revisionist powers, China, Russia, Iran, and North Korea. They are challenging the economic, political, social, financial, trading, and geopolitical order that the US and the West created after World War II. Unfortunately, these tensions are rising. A new Cold War is coming. This Cold War is becoming colder, and there is even a risk of hot war. For the first time in decades, there is a risk of literally hot wars between great powers, starting with what happened in Russia and Ukraine. 4 types of mega threat. There is significant amount of social political instability due to economic malaise, poor economic future, and a rise in income and wealth inequality. There's a backlash against liberal democracy, and now radical, extremist, populist parties of either extreme right or the extreme left are coming to power, both in advanced economies and in emerging markets. There's a risk of civil strife, even in the United States, as we saw what happened January 6th of last year. 5th, the kind of damages coming from global climate change is not in the future, 5, 10, or 20 years from now, it's today. Just remember what happened this past summer, where you had massive droughts in India, in Pakistan, in Sub-Saharan Africa, throughout Western Europe, in the United States, all the way from Colorado to California. There's a massive multi-decade drought. 1/3 of all vegetables, 2/3 of all fruits and nuts in the US are produced in California. Today, there is not water, and the farmer prefer to sell their water rights to industry rather than producing produce. That's why there was a spike in food prices even before the Russian invasion of Ukraine. Desertification, lack of water is going to lead to massive problems of food insecurity. There is food inflation in advanced economies, but in emerging markets and in poor countries, not just food inflation, it's food insecurity, the risk of famine, of real economic and financial disaster. Given all these threats, of course, there is significant pressure on governments to try to react and to maintain some form of stability for their nation and economies. However, many countries make mistakes, And these mistakes have significant and catastrophic effects on their economies, on their markets, and on their own welfare. Look what happened recently to Russia with this very poor decision about brutally invading Ukraine. Look what's happened to the United Kingdom when you had loose fiscal policy and market reacted violently. The US, that is the strongest economic and political and geopolitical power in the world, is not immune from these pressures. In the last decade, with very loose monetary, fiscal, and credit policies, and with a polarized and divided political system. And this loose monetary, fiscal, and credit policy have led now to inflation and the risk of a debasement of the value of the US dollar. So even the United States, that is the strongest power in the world, is subject to these types of mega threats and therefore has to deal with it. If you look at it more broadly, we had 30 years of what people refer to as the Great Moderation. Inflation at 2% or below, stable economic growth, and rising value of risky assets like US and global equities, while there was a fall in bond yields because inflation was falling. So not only equity prices were rising, but also bond prices were rising. So you made money on your bond portfolio and you made money on your equity and risky asset portfolio. Unfortunately, this period of great moderation is over, and we're entering a period that I call of great stagflationary and debt instability. There are reasons both on the supply side and on the demand side why that's happening. On the supply side, of course, the rise in inflation has been driven by some short-term negative aggregate supply shocks. The initial impact of COVID on global supply chains, on the supply of labor, and on the production of goods and services. Second, the brutal Russian invasion of Ukraine led to a spike in food prices, in oil prices, in natural gas prices, in fertilizer, and industrial metals. And three, this year, the continuation of the zero COVID policy of China has led to further supply bottlenecks. However, in my book, I suggest that there are other medium long-term forces that are also stagflationary. I identify 11 of them. I don't have time to go into much detail about them. I'll give you a brief summary. These are all forces that reduce potential growth, increase the cost of production, and with loose monetary and fiscal policy, they lead to inflation, recession, and stagflation. We have deglobalization and protectionism, secure and fair trade rather than free trade. We have reshoring of manufacturing from low-cost China to high-cost Europe and the United States, friendshoring instead of offshoring. We have aging of populations, not only in advanced economies, but also in key emerging markets like Russia, South Korea, and China. We have restrictions of migration from south to north, from poor to rich, to the US, to Europe, that are increasing wage growth. In the past, migration kept the lead on wage growth. We have this decoupling between US and China. It's going to lead to a more divided and fragmented world. We have global climate change that has significant stagflationary impact. The previous speaker spoke about the implication of it, for example, for energy prices. Of course, desertification leads to rise in food prices. We have pandemics, and COVID-19 is not going to be the last one, because the relation between climate change and pandemics, and they lead to negative supply shock that reduce production, increase the cost of production. You have cyber warfare that reduces production, or if firms and government have to invest to protect themselves, is costly and increases the cost of production. There is the geopolitical depression that's going to lead us to a divided world, fragmented world, balkanized world, decoupled world, protected world, in which this division are going to reduce growth and increase the cost of production. Final two factors. We have a backlash against income and wealth inequality, rightly so because of the rise in inequality, and now fiscal policies are becoming pro-labor, pro-union, pro-workers, pro-unemployed people, pro-minorities. Rightly so, because otherwise you're going to have social strife, but that's going to increase reservation wage, it's going to increase the wage and price spiral. Finally, the US is using now the US dollar as a weapon of foreign policy and national security, imposing trade and financial sanctions against its own strategic rival. Used to be Iran, North Korea, now Russia and China. While that may be necessary for national security purposes, it leads to two problems. One, the risk of de-dollarization and people moving away from dollar assets. Secondly, In order to have an international financial and trading system that works, you need something that finances it with low cost. If you create friction and sand in the wheel, that increases cost of production and is therefore stagflationary. On the demand side, there are also forces that are leading to inflation and stagflation. We are in a world in which there is so much private and public debt that central banks that try to fight inflation are going to cause not only an economic crash, a hard landing, but also a financial crash. And therefore, I believe that central banks are going to wimp out, they're going to blink, because faced with trying to fight inflation, having economic and financial crash, the alternative is better to monetize these large deficits. So the combination of supply shocks and loose monetary, fiscal, and credit policy is going to be inflationary. Now, what are the financial and investment implications of this world where the great moderation is over and the great stagflationary and that instability is upon us? A traditional paradigm for investment is 60-40 or 70-30 or risk parity. You put a fraction of your wealth into risky assets like US and global equity, and you put another fraction in safe assets like long duration US Treasury or similar types of bonds. That paradigm assumes that there is a negative correlation between the price of bonds and the price of equities. And that's usually the case. Risk on, risk off, growth, recession. If you make money on one part of it, you lose money on the other one, and on average, you're doing well. However, that assumes that inflation is low. If inflation is even gradually rising from 2% to 5-6%, you lose money like you did this year on your equity portfolio, because the discount factor for equity is that the bond yield is going higher. So that's why US and global equity have gone down by 20% this year. But the rise in yield in US from 1% to 4% for long-term treasury implies that the price of those bonds falls as well. And you lost actually this year more money, 25% on long duration treasuries than you did on equities. So today and this year, for the first time in decades, there was a positive correlation between bond prices and equity prices. Both of them fell. So there was nowhere to hide. Think of it, there's $20 trillion equivalent of long duration dollar-related assets that are fixed income that are at risk. The yield today has gone from 1% to 4%, but if inflation averages, say, 5 or 6% in the next few years, as is likely, then those bond yields are going to go towards 8%, if not higher. And the spreads over those of the private sector are going to be double digits. So the losses have started, have been severe, but they're going to be much more severe. And here I'm not assuming hyperinflation or even high inflation, not even double-digit inflation. It's enough for the average inflation in advanced economies going from 2 to 6%. You'll have additional massive trillion-dollar losses on your fixed income investor. And whether you're a sovereign wealth fund, whether you're a private or public pension fund, a family office, an endowment, a foundation, or any type of traditional or alternative investor, you're subject to this kind of risk. So we need alternative assets that protect investors' wealth against inflation, debasement of fiat currency, socio-political and geopolitical instability, and global climate change. And if the US has to remain a safe haven for investors, we need to rethink the traditional fiat-based monetary system for the US and for the global economy, and evolve it from a trust-based system, this fiat, to one that is rooted on real financial and real assets. This is going to be a win-win for both investors and governments, as people are going to continue to invest in US dollar assets, but they're going to maintain also the national stability. That's where this Atlas project comes up. I'm very happy to announce today that after 2 years of work, we've launched just this past week a new index, the Atlas Capital Benchmark Index, that is live today on Bloomberg, an index that we developed together with Goldman Sachs. This index has 4 features that are important for investors. First, the composition of the index is a combination of real and financial assets that provide you a hedge against tail risk of inflation, debasement of fiat currency, political and geopolitical instability, and climate change. It's a combination of short-term treasuries and inflation index bonds that reprice when inflation is higher, gold, precious metal, and eventually green metals that are hedged against a variety of risk, including the one of climate change. And we want to invest into stuff that usually does well when inflation is high, like sustainable real estate, commercial and residential. And we do it by choosing those types of public REITs that are actually resilient to global climate change in North America. All these assets, whether it's treasury, gold, other commodities, or public REITs, are highly liquid, are highly safe. And they are a much better alternative to long duration fixed income, and US Treasury is going to be subject to significant additional losses in the next few years. Secondly, we have both stress tested in periods of crisis and back tested for 50 years since the breakdown of the gold exchange standards in 71. And you find that this investment gives you good returns in normal time, high single digit with low volatility, but then whenever there is tail events like a rise in inflation, of course, the returns are outsized even on a risk-adjusted basis in volatile times like now. 3, we do believe that doing well is not inconsistent with doing good. And in this world of volatility and instability, we have also to do good for the common good of the world. That's why we invest into the right types of commodity. They give you food and other types of security. That's why we want to invest into infrastructure, commercial, residential, real estate in the part of North America that are sustainable and they are resilient. So we have to think not only about doing well, but also think about the collective health and prosperity of our own communities. That's why that's also key. 4, over the next year, we're going to develop a series of products. We started with an index over which you can essentially do total return swaps. The next step is going to be having ETF based on this index. And finally, we're going to have digital security tokens that are fully backed by real and financial assets, not vaporware like most of crypto. They're going to be backed by real financial assets, fully compliant, fully regulated, fully supervised with 100% MAL and KYC. A few final remarks. This is not just another investment opportunity. We have a longer-term vision about what Atlas should be. We're thinking about the new monetary system for the US and for the world economy, a new international store of value that could eventually have some even means of payment features over time. The idea of having an alternative to the fiat system is not new, and we've seen a bunch of suboptimal attempts at this concept, like crypto. But crypto is not safe, is not secure, and is more fiat than fiat currencies. However, if we have to build a new option for nation states and global institutions, we need some basic features of this new store of value. It has to be stable, it has to be scalable, it has to be secure, transparent, non-speculative, adoptable, fully regulated and supervised with ML, KYC, and asset-backed rather than being based on nothing, fiat, or vaporware. Secondly, there is a public policy element to our project. We have forged a true private and public sector partnership to ensure input, adoption, development, and distribution from all these partners from the beginning. That's why we're working with sovereign wealth funds, custodians, banks, regulators, and governments to ensure that this is a collective effort among all of us. Third, in these volatile times, we need collective responsibility for the common good. As the fragility increases in economies, in financial market, and geopolitics, it's our collective responsibility to devise financial instruments that are more stable and secure. And as the world deals with increasing health, human, social, climate, political, geopolitical crises, it is also important that our investment deliver value beyond returns and do good for the broader society, not just do well. Final observation. As I pointed out, a series of very severe mega threats are upon us. Until now, we've been kicking the can down the road. We've been putting our heads in the sand like ostriches and not addressing these severe problems. The time to act is now. We need to build a new economic, financial, and trading and political system that is stable, that is sustainable, that is inclusive, that is cooperative, that does good while doing well, that is secure, that is fair, that is dynamic and progressive. This is necessary if we want to continue for the next decade to have peace, prosperity, and progress like we had for the last few decades. Otherwise, we're doomed. Thank you very much.